The test is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the latest webinar in the Infrastructure Journal webinar series, in which we will be debating infrastructure debt and how institutional investors can access the market. I'm Infrastructure News Editor at Infrastructure Journal. Following the session this afternoon, before to my esteemed colleagues on the panel, a few housekeeping rules. If you're hearing, please notify us by using the chat box on the GoToMeeting panel. We like to be as interactive as possible, so please feel free to ask questions using the questions function on the panel. Now, I would like to introduce you to one of the experts. Today, I have Alistair Higgins, a director at ING Bank and a component of the bank's Pebble project. A director at Sequoia Investment Management and lead infrastructure analyst on the Sequoia Infrastructure Debt Fund. Silja, senior infrastructure finance advisor at Legal and General Investment Management and founder of specialist investment advisor and investment manager Eagle Oak Capital. Pillay, vice president in the infrastructure structured finance division of Bank of Tokyo Mitsubishi. Holmboe, an associate in the investment consulting team at pension fund consultancy firm Redington. And on the phone, Anne Christine Champion, Managing Director and Head of Global Infrastructure and Projects at Natixis. Investors and infrastructure debt are two phrases that are fast becoming synonymous with one another. As long-term bank financing becomes continually constrained, government sponsors are looking for alternative sources of long-term financing for infrastructure projects, and capital appears to fit the bill. Infrastructure debt offers pension funds and insurance companies long-dated, stable returns and a good asset-liability match. The number of institutional investors looking to infrastructure debt as an asset class for investment is on the increase, but the question is, while interest is clearly on the up, what are the avenues for entry for these investors? Greg, you can start us off on this point and talk about infrastructure debt funds as an option for accessing the market.
Sure. The investor interest in the asset class is documented, and I think you have the question, how best can investors access the opportunities? We believe that a mix, a good diverse portfolio can be created by an independent manager selecting assets from a variety of sources, be that banks or perhaps even sponsors directly. A mix of secondary as well as primary also provides an opportunity for investors to benefit from the reduced default probability as these assets age, but at the same time participate in new financings, which we think will be the bulk of the market going forward, where the opportunity to share in upfront fees gives them an opportunity to enhance their yield. So we've been looking to identify opportunities to develop a diverse portfolio to allow investors to outsource their sourcing of loans as well as the credit review for those investors that don't have that capability in-house.
Thank you very much for that, Greg. And infrastructure equity, a number of the larger players in the market, consider directly investing in infrastructure. So Legal and General is one of the larger institutional investors in the market. I mean, what's your view on how to access infrastructure debt?
We would probably see that there'll be a range of different things that work for different types of investor. I think probably large insurers like large pension schemes will probably take seriously, like us, the opportunity to invest directly. But large insurers, I think, will be driven to go largely down that path. And across our client base, we see a lot of even significant pension schemes that will probably should look very seriously at things like their fixed income mandates to see whether those need to be expanded to cover private opportunities. And I'm sure funds and methods will have a significant role. I think it will come down to how much people feel they actually have in terms of not to invest in the asset class. So if total appetite level is 50 million or 100 million for private debt assets, clearly somebody that's going to be looking at a fund perhaps. But if, some of our internal clients, you're looking to get into, single digit, high single digit, or, double digit billions, then you probably need to have a hefty amount of direct investment to get there.
Okay, Conrad, I mean, from the perspective of your clients, what's the view on how to access the market?
This is something we've explored quite a lot the last couple of years. The problem that we face with a lot of our clients is, I mentioned different ticket size. We'll try and look at different solutions for them. But over the year, we essentially RFP'd quite a lot of asset managers out there to determine what solutions asset management solution providers come up with. And we found that if you go through the direct routes, you have to have scale and you also have to have the skill set to do that. And I think that's quite hard. Most of that resides with banks. If you have co-investment, who are you co-investing with and how do you align that interest? So you're co-investing with a bank. We think that has some issues, but you can get that. But with the actual individual funds themselves, so the actual fund management, we find the biggest issue with that is that the actual fees they charge are quite onerous. If you think about what you're trying to get when you look at infrastructure debt, is you're looking at essentially credit, long-dated credit, with liquidity stroke complexity premium attached to it. Now, the fund looked at, the fees were quite high, and basically just took out that illiquidity premium out of component. So the way we've approached it is actually try and actually get pensions together, aggregate their requirements, which is hard, but we're working towards that, and actually go into the market and go, this is what we're looking for. This is these houses we're looking for. These are the fees we're looking to charge. Can you do that? And we're having some success with that, but with everything, it's a challenge.
I think there may be a difference here in terms of historic sort of specialist investment managers, and I think there's a difference as some of the very large investment managers expanding themselves, what they're able to offer our external clients in infrastructure. I would even a new wave of investment management in infrastructure, which I think really will be what we need to be real grow up, coming of age of investment management specifically in infrastructure. I think that evolves very much to deal with client concerns as you know, in Redington campaign.
I think that's fair, and actually over the last couple of months we are seeing dramatic change in perception in terms of charging of fees. If you're looking at secondary debt, and probably I think a different skill set, but secondary, the skill really isn't acquiring it, managing it, making sure there is no credit event, but it's quite as complicated as primary. I think the fees should reflect that, and certainly the industry is moving much more in that direction to where it was a couple of years ago.
Yeah, I mean, for me personally, is it a question of primary or secondary? I think the top investment management firm should be really thinking about is where is the value, what is the value, and what is in the industry and in a market that is appropriate for each individual client's requirements. And it's really those two things that should be absolutely top of the rather than overly on primary and secondary, albeit that obviously access to enough value, get the value that's out there is obviously key.
Trusha, do you have anything to add to that?
The point I would make, just a little bit at odds with the approach you take, is that we start with the client, start with the contracting authority, and account how to actually deliver, for example, bid support, and ensure that the process continues for those projects that are being undertaken. And of course, then look to the institutional side to see where that appetite and interest is, and all three of you identify different needs and different specifics to what you're looking at with some commonality. What we're trying to do is take out some of the books to turning those bid support into something that can be delivered from the institutional side. So take out cash management, take out waiver management, take out some of the concern about the sort of alignment of interests between banks that still the authorities, banks that know the space. Because those clients still need commitment for bids, they need equity pledges. The authority needs to know that there is commitment from the market, and you still see, although institutional investors are progressing almost in the right direction, it's still looking for a yield here for an asset. It's less alignment with the ultimate side of the contracting authority just for an asset. That would be the slight difference of coming to the same solution ultimately. And what we've done in that order is to sort of break it down so that any investor can participate in that structure. As well as maybe.
Yeah, I think from the side, from our point of view, we're probably quite aligned with what Alistair's mentioned, in the sense that I suppose from a bank's point of view, we're looking at it from the client perspective, as in from the very early stages, and more with a bird's eye view as to what else is out there in the market, and effectively, you know, what we bring to the party, but also what we're competing with. And in some cases, it's not a question of competition, because some projects are actually sufficiently large for everybody to really need to be in the game in order to get to play. So what we're seeing, I suppose, is in terms of answering the question is how infrastructure investors can actually access infrastructure debt. There's just such a variety of ways. I think you're hearing around the table from people with slightly different perceptions and different interests saying that, well, how they would see it. But I think from our side, it's not mutually exclusive. I can debt funds getting into co-invest arrangements with people. I can imagine banks still being in with long-tenor debt sitting alongside institutional investors. I can see banks doing short-tenor debt sitting in alongside institutional investors. There's just such a whole host of different opportunities. And I think where we are is quite an exciting place in the market, because with it evolved, and it's really up to sponsors, banks, investors themselves, authorities mainly, really in trying to drive it forward and develop it and put it into the way that we need it to work in order to actually get an infrastructure pipeline done.
Yeah, without any alternate structures, because what we don't see is a proprietary model to pervade the market that blocks out source of funds, because at the end of the day, with money the same colour, it funds an infrastructure. We need to get that client getting the best access to liquidity. So sorry.
And if I may, yes, just maybe a word, I think, in terms of access, we've been discussing direct lending from investors or through a debt fund with asset manager. I think there is also a third way to access the market, which is the partnership approach between the bank and investors. I think there is a good complementarity between what the banks and investors can provide to the market and to the granting authorities. And this is what we've developed with Natixis. We've set up a partnership with AGEAS, who is the first Belgium insurance companies. And in a concrete way, we've transferred already three infrastructure assets to them, and they are for 130 million euros. There are 300 million euros under review with them. And the partnership approach is based on the alignment of interest. I think this is something we've been saying, but that Natixis will keep part of the transaction of the credit on its book, which I think is one of the best ways to get this alignment of interest between the bank and the investor. But it's also providing servicing to the investor in the analysis of the project, and even more when we have this construction period, which, as we know, is one of the periods which might be somehow difficult in terms of access to the asset class, and also quite a competitive pricing, because there is only two entities, the bank and the investors. And that way, which will not be the only one, but for investors who are willing to invest a sizable amount in the asset class, our partnership is for 2 billion euros amount over the next 3 years, is I think a good way, because the structuring elements which have to be modified to make the investors present or available for this asset class can be included quite early in the process. So all the topics that we'll maybe discuss afterwards, but about make-all payments, etc., can be included by the bank in the discussion we are having with the sponsors and the granting authority, and that are needed by the investors.
Thank you, Andy. Does anyone have anything to add on that point? Then often we talk about institutional investors and infrastructure debt. There's an emphasis on the rating of infrastructure debt and whether it's an attractive investment opportunity. It's a traditional BBB rating. BB's Project Bond Initiative, for example, has had a sharp focus on rating of infrastructure debt and ways to enhance the credit rating. But is enhancement really necessary, and do investors need to have that A- debt? I mean, Alistair, maybe you can start us off on that point.
The 2 points I'd make. The first isn't so much on the credit enhancement, but to the extent that an institutional investor that had a perhaps less intensively resourced ability to analyse deals, they want to know that a rating institution or an institution that is putting product to them with that opportunity, real skin in the game and real alignment of interest. So I think an enhancement product can help in that respect. And clearly you have a few products in the market that achieve that. other is, though, that it can simultaneously be used for credit enhancement. We see, and everyone talks about that magic single A, but we also see quite substantial appetite at lower sort of investment grade levels, and it's up to a sponsor to determine how they want to pitch their deal, because you will find, most typically, that up to single A you will find lower pricing, but it's the cost in getting to that lower pricing. So it's also that can find and source that liquidity together with banks that can help, or even institutions, may well choose that the triple B level is more attractive. And one with Pebble can allow you to choose that level you want to go to. Obviously, a form of enhancement product, but it's not for financing structure to determine or force upon a sponsor their bid strategy. I think it has to give that option to all potential participants.
Yeah, and I think as a bank that's been in the lending market quite actively over the last few years, and certainly as you know, long-term finance has been drying up a bit more, and we're still active in it. We've certainly seen a situation where it's deal size and liquidity requirements that will really drive where a deal ultimately ends up in terms of its financing structure. I think Alistair's point out there are many investors that are actually quite keen in the triple B asset. It's completely correct, and investors are after the yield that they provide. But you might find deals where, because of the size, capacity might become maxed out in terms of being able to actually attract enough liquidity at the triple B level for a particular type of deal. And I think where we would see it happening, or see change occurring, is really there are large multi-source financings required, where perhaps you would need an enhanced piece to fill a gap. I think from our point of view is the pipeline is actually not so enormous at the moment to see these happening imminently, in the sense that they're not in the pipeline at the moment, but there are some deals that are coming up where you could start to see enhancement products being required more.
I think when you look at what investors need in order to be motivated to come into infrastructure debt, the yields are more akin to a triple B credit equivalent. So I'm not sure that investors are willing to take the reduced yield that's necessary, as Alistair says, to get you into an A-minus credit rating.
To a degree, it depends on the type of investor, because certainly historically insurers went their sweet spot was probably in triple B. Be flat, there was always a big cliff risk as it's been going into non-investment grade. And this is obviously one of the big hot topics for insurers, a new capital regime, which is, you know, a concern that limiting the amount of triple B potentially to 15% of your investments matching assets. You know, if it were to be as draconian as that would be a real shame, and certainly insurers, I think many people believe, you know, infrastructure triple B investments should be quite a comfortable place to hold assets, and we're playing a role ourselves in trying to be able to be free to take the best economic decision for annuity recipients in the future, which is to invest in that place to generate the best return on a risk-adjusted basis.
The other thing that's interesting about this asset class for investors when they're looking to other alternatives, comparing it rather, is the sort of built-in improvement in credit quality over time. You know, so these may start out originally as a borderline or triple B investment, but that gets sort of 4 or 5 years in, and solid if you're talking about a very high-quality availability payment stream. You know, you're already getting a 4 or 5 notch rating upgrade potentially.
One point is that investors in the single A, and not taking away from there's a lot at the triple B, but who have to have single A, are really the people on these calls, in these discussions, in these panels. Right. They don't know so much about infrastructure, and that's why they see single A as their way of not having to know as much. They're still sophisticated investors to a point, but they use other proxies as to their investment appetite. And so we rarely see them come to the same conferences and make the same remarks.
But I suppose the point is that particularly still exists.
Yeah.
So to the extent that it is capable of being tapped and can be going forward, that there's probably, you know, there's some merit in structures being done on the basis of a credit enhancement. I suspect that what will happen is, if it doesn't need a credit enhancement, it simply won't be done, obviously, on that basis. But when it does, that would be the interesting
cost at least.
Yeah. From an investor point of view, I think we'd probably be a bit wary about having a sort of level playing field for capital between banks, pension schemes, and insurers that then leads us to have quite specific types of credit enhancement here and there. We'd much rather have a level playing field for long-term capital, so that if something is a good quality triple B, that would be without it then needing to be pushed and pulled and twisted and turned to make it a single A. And I think we probably would not be in that approach either. But credit enhancement may be a necessary aspect of new regulatory treatment when it comes in.
Okay. Christine, did you have anything to add to that?
No, I agree with what has been said, is that liquidity is still there, and that the pricing that could give the CLA will not be sufficient because there is a lot of appetite for triple B rating, and credit enhancement is also putting a new counterparty in the project, so counterparty risk on the credit enhancers. So fully agree with what has been said. Okay,
so to move on then, just to something that was kind of mentioned at the beginning, the conversation between secondary and debt and primary debt, and I think the main challenges the industry faces is the slow pace of transition between moving from secondary debt to primary debt. I mean, institutional investors have shown favour for secondary infrastructure debt. It gives them easy access to the market and an immediate return. At Redington, working on your platform to partner investors with secondary debt, I mean, is what you're seeing that the most opportunities with secondary and the most interest is with secondary?
I mean, I think now the opportunity really lies in secondary debt, and I think that's a function of two things. In the first instance, we're just seeing a lot more secondary opportunities. Banks deleveraging as creating opportunities for institutional investors to step in and buy secondary portfolios of PFI loans or refinance a core infrastructure at pretty attractive levels. That's the first thing. And the other one is really, from a pension scheme's perspective, why are you investing in infrastructure? Obviously, you want them to secure cash flows, inflation linked if possible, but really the idea is you want a diversified pool from day one, and you want cash flows from day one. And that's really what secondary debt gives you. With structure risk, rightly or wrongly, there's an aversion by trustees and schemes in the UK against it. Now, solving that is going to require globally in terms of education process and the like. And I think it also requires a little bit of help from the government. I mean, the PF2, the docs of trying to get pension schemes to invest in infrastructure by making it less risky, reducing the returns which need to reach full funding, is quite risky. But also, what infrastructure projects are there right now in terms of primary? There's not, it's not a question of we're turning them down. We don't think they look attractive. It's just we don't really get to see them. I think that's really why the focus has been on secondary as well.
Okay. And Greg, I mean, your fund is going to be seed with existing project finance loans. But you mentioned that you will do a combination of primary and secondary. I mean, from your investors and your clients, what kind of interest are you seeing from them, and what kind of awareness are you seeing from the primary market?
I think investors are looking for an opportunity to come into a diverse portfolio, and that's diverse by certainly on our Euro fund by geography as well as by asset type and involved. They have different risk tolerance for construction. My own background is the U.S. municipal bond market for the first half of my career, where institutional investors take construction risk all the time, and they get comfortable that there's sufficient mitigants. So I think I would hope that the market would move in that direction, and investors will get comfortable that if the manager or the bank structuring the transaction have done their homework correctly, that the construction risks are adequately mitigated, and convince them that they're adequately compensated for that in terms of if you share in some part of the upfront fees. So we believe that by looking at both secondary as well as primary, we can deliver the best opportunities for investors. There's a limited amount of secondary available that be acquired from banks, given the if the loans are too old and the margins are too low, the banks can't sell them without destroying capital. So I think into this market and say that you are only going to look at secondary, would be a limited strategy.
That's right, but I think for trustees, so you've got the larger pension schemes who've got their own in-house teams and they're sophisticated enough to look at that. And insurers likewise, but for the majority of pension schemes, they have a trustee board comprised of 10, 11 members, and they haven't quite got the governance in place to actually assess this kind of thing. So we get primary, I think, for the sector as a whole to move towards institutional investors and pension schemes investing in infrastructure, that would be a gradual process. I think if you go to them and go, here's a solution, it's got credit enhancement, it's got this construction risk, bank stepping in, I think that successful, but I think it would be very hard to sell. You're actually getting, you get secondary PFI loans, it's pretty stable, you know what the return cash flows are, you get to understand the profile and how it behaves. Little, they'll start to inquire, the manager then go back to them and go, well, what about primary, what about refinance, what about refurbishment, brownfield? I think that opens up further avenues. I think if the industry as a whole gets more and more technical in terms of the solutions they provide, that's probably the way forward.
I suppose it goes back again to the comments we made very much earlier, which depends entirely on how the institutional investors are set up themselves and the level of, I wouldn't say sophistication, but the level of input that people are willing to put into it, the team that are sitting behind them. Like, Silja, you're coming at it from a completely different position because you would be doing the analysis in the same way that people would be expecting banks to, for example. So in that way, I would think that primarily quite attractive as well as secondary.
Yeah, no, in terms of resource, that isn't so much an issue for us, but I think for a lot of pension schemes, you know, it will be very thinly staffed in terms of investment personnel. There is a real issue of, aside from creating greater benchmark bond issuance, which is a perfectly acceptable route that is there right now today, and it may well be that that is, you know, for those that have corporate mandates, it may be in the future that is just the simplest way to get a class into some pension schemes books. But for those who have interest in broadening their exposure outside of that, I do think that Conrad's point is a very wise one, which is that the more the product goes down, that other sector goes down a very specific, detailed, highly structured route, that makes it even more difficult to bring in some of those pension schemes. Now, if they're small schemes, the bond market is the option, but it would be nice, I'm sure, for them to feel that they have the same choice and that they have the full menu able to be eaten. To say that the large investors can, I think it is very interesting to see the forms emerging as a way, sort of a democratization way of investment in the sector, which, you know, we certainly we're very supportive of. But yeah, I mean, there are a number of things that will need to be wrestled with, but we come back to it all. I mean, really the big pension schemes, and it's the big insurers at the moment that probably do have the ability to keep the market moving forward in terms of you know, the private and public part of the market. And I think there are a number of interesting things that really need to be worked out over time to really spread infrastructure everywhere there is genuine real appetite for it.
I think keeping the skill set, I think if pension schemes take on a whole team just to look at infrastructure, that might work. They might allocate 50 million, 100 million, you're not going to hire 20 people for that. Yeah. But I think a solution could potentially be where banks who just do this, that used to do this, pay it out, provide the construction finance, and it's up with an agreement pre-construction with a pension scheme, then into those risks reduces reinvestment risk. It's quite an agreeable solution. There's a lot of work to be done with that, but that's something that, you know, we'll to explore and see whether or not that can be sophisticated. But if you try and make pension schemes take on risk, they're not built to take on, or haven't got the expertise to actually then quantify, then I think some scenarios can be quite disastrous in the future.
I think for the drivers for this, so you start with institutional investors that says that ideally I want a 3% margin and no construction risk and a very sort of benign operational risk. And Darla, we've seen over the course of the last couple of years, and you now find those investors saying, well, okay, I recognise that those don't exist, so I'm going to look down the yield expectation and I'm going to move into taking some construction risk, albeit that I want some sort of protection. I want to know how it's being done and have some oversight, whether it be through fund management or other types of product. It's at the point that crosses over with the bank appetite to do that sort of breaking through, and right now we're just not quite there. It's still still just competitive enough, and the institutions are for saying, well, I don't give too much. I want to be at least as expensive as a bank. The will only go for the cheapest solution. I mean, at the end of the day, the bidding a competitive process, so they need the cheapest solution out there. Banks always just pushing just under the pricing institutions.
And I think construction risk is actually a very interesting point, because you've mentioned, Conrad, that seeing some sort of solution where construction risk is bridged by banks in some way, or perhaps guaranteed in some fashion. A bank would have to take a long-term view in order to be able to do that, because the bank would have to look at a project and say that the construction guarantee, as it were called, they were to be in it for the long term. So I think that's really the sensitivity, because we're talking about long-term market not being there, us need to bridge construction, but actually the only way you can do that is with players that would be willing to be in there post-construction for a certain length of time if it didn't work out.
It's a solution for institutions, not a solution for banks.
Correct.
Yeah. I'm not a bit surprised.
Yeah.
And with your with AGS, I mean, what's the view on construction? Are they willing to take risk?
Yeah, they are taking that risk, but alongside Natixis, as the partnership is based on a line of interest, and we are providing the servicing of the credit. Servicing of the credit is post-financial close. We are doing monitoring of the credit, sharing this with AGS, which is, however, keeping the investment decision. So they are a lender. But they're keeping the investment decision for whatever waivers or covenants or any decision. But this part of the partnership, the servicing, we see it as a key element for the access to the asset class, and particularly during the construction period, which is one of maybe the challenges of infrastructure debt. We've also explored solution to have a bridge by a bank and a commitment from investors to be there to refinance finally this construction bridge. I think this has already been done, not in Europe, but in other jurisdictions. This is also a way to do it. However, what we see from investors, but there are also a lot around the table, but there's been a change and an evolution in the last 18 months on this construction period. I think that 18 months ago, construction risk was not something that investors were really keen to look at, and it's now changing, because this is also where you can get higher remuneration. So it's just a balance between a risk you are comfortable with and return you can get out of it.
There's one thing Anne-Christine said, though, which is very important and clearly being achieved with the solution they have with AGS, is that servicing of the loan and sort of co-managing on their behalf. Because when you look to the EIB solutions with project bonds, SE have commented that they view as a potential risk if you don't have an active sort of party to do a waiver on behalf of those investors. And that they see those credits sort of negative. And clearly what Anne-Christine there is doing is sort of bridging that lack of resourcing that an institutional investor may have. And even an investor that wants to get up to speed perhaps doesn't hire a whole middle office that a bank does with cash management and so on. So a very important feature to have when you're going through construction in particular is to make sure that the institutions don't have to call from the builder telling them they want to paint another line down the middle or put some more rooms in for emergency phone calls. You know, that's a complexity that perhaps is not what they want, no pension fund manager.
Mm-hmm.
Yeah, I think it depends on investors, but it's not acting. We're not acting on behalf of AGS, as I mentioned, that they're keeping the investment decision, but there is a servicing of this, and we've been working around this servicing to make sure that it's what the investor and AGS was looking for and what can fit into the structure. Also, I think from a sponsor perspective, it's also something very beneficial, because I think one of the fear of on the sponsor side of the institutional investor solution is that there are new counterparties around the table when they have to discuss is there a large waiver or whatever. And I think the fact that banks remain on the project with a interest and there is a presence to do so is I think, a good element. And I think if you look at the Canadian market, who's quite active in terms of project loans, this is also how it works with the bank acting or working when there are large waivers.
Thanks for that. If we move on to talk about, we kind of understand that investors need to get familiar with primary debt because, secondary debt, there's not going to be enough there to keep the market going. There are challenges the prime market throws up. A few we've touched on, talking about appetite for construction risk, but other issues that have come up are, things like procurement process, the ability of institutional investors wanting to offer fixed rate rather than a variable rate loan, and also concerns over prepayment. Did you want to start off talking through a few of those points?
I think from our point of view, it's probably, we see this sort of issue coming up quite a lot, simply because we're involved in transactions from the bid phase, and as a result are constantly or frequently asked by sponsors to be able to put terms and actually commit to pricing in some way. And simply that would be a commitment for a certain period of time on margin. But we expect that there will be some sort of repricing and funding competition, or perhaps something, some sort of structure going forward where actually the price is revisited. I'm frequently bemused in terms of the idea of being able to hold pricing and institutional investors not being able to hold pricing. And I think you've got to distinguish there between what could be private placement markets compared to public bonds, because I think that issue is more pertinent on a public bond where you actually don't know the price until such time as the bond is actually done. But private placements, I think increasingly we're probably hearing about more investors that are prepared to effectively not quite hold or commit to pricing, but give more of a firmer statement as to what the pricing will be. And in those instances, I would say that actually the position is not much different where banks would be, because LIBOR is moving around, and if procuring authorities can take LIBOR risk, there isn't any reason really, if they have an idea of what the indicative spread is, to not take the risk on the swap. So I just, there's so many issues to pan out and so many issues to see work through, but I think people need to be open, and authorities need to be open to the fact that actually it's incremental changes that are needed and not enormous ones in the procurement process in order to be able to address these issues. So that's just procurement. And of course, looking at documentation, which is a basic one, project documentation issued in fairly standard form, subject to certain criteria and certain abilities to be able to open up discussions on it. But authorities need to actually demonstrate that they are allowing institutional investors to be able to enter the process by addressing issues like spends, by addressing issues like, the fact that there might be orphan swaps, that might be banks are providing inflation swaps, for example, alongside a private placement or a public bond. So yes, that's how we are seeing it at the moment.
Okay, and Greg, did you want to start to maybe talk a little bit about prepayment risk? I mean, is that something that's a concern for investors?
Well, I mean, certainly the ability for the existing secondary loans to prepay, it's been a floating rate market and it's been a prepay market. That is an issue for a lot of investors. I mean, we've done a lot of work with investors to get them comfortable, about the mitigants to that risk. The profit area in the public sector, there's the expense involved in going through a refinancing transaction, as well as the amount of time for limited savings. But it still remains an issue for investors. I think moving forward, there will be movement on both sides, both hopefully from the procuring side in terms of flexibility to offer spends and so on, and perhaps consider fixed rate financing alternatives. And I think we'll also see movement on the investor side as well, getting more comfortable with the asset class and accepting, particularly in a case where we have a diverse portfolio, we might have protection on some assets, but not on all of the assets in the portfolio.
Okay.
From our perspective at Jim, I mean, the really key things for us are, getting sensible outcomes on capital treatment, so that doesn't get in the way of we see as very good quality asset class where it's done properly. So that's key. I mean, certainly procurement and just the industry generally. I mean, I've been working in institutional investment for a long time, and it's always been a very bank-focused market, and it's very refreshing to have the sort of open conversation that we're having, with people in banks as well these days, and I think it's a real sign of how far things have come. I think sometimes really for borrowers, where there's the biggest challenge of truly trying to understand all different types of investor out there, and there's certainly a lot of organisational inertia in getting institutional debt products to win in funding competitions. But we're encouraged with the progress that's been made, and feel things are looking quite bright for this year.
For avoidance of doubt, it is almost with exception that prepayment protection is required when we look at institutional investors coming into this asset class. And we've been spending a lot of time going to authorities and to explain this to them, to eventually get that sort of idea as they think of it. It's not all that different to the swaps repayment, albeit the swaps can go positive or negative. You don't know where it might ultimately come out. But having achieved that and having got that from some of the procuring bodies, the upside should be far outweighing. The question then becomes, how much prepayment protection, how much do you want? And obviously, you ask that question to an institution, they'll say 100%, and some of them are even cheeky enough to say, I want my FX risk covered as well from an currency that I'm funding. Now, those two asks are, to my mind, a little bit too much. We push authorities to something that we think is more sort of market receivable market norms, and most typically that's a modified spend clause of some sort.
Yeah, and for insurers, prepayment is now even more prescribed in regulatory capital regulations, and it's frustrating because sometimes there can be good value in loans, and it's a shame to discriminate against one whole area of investment activity, and that's still very much a work in progress from a regulatory perspective. So the driver is probably an immovable one in terms of regulation.
Once you get one authority to agree with it, you have to move on to the next one.
Yeah, it's sort of unforgiving.
So if there's any authority who's on the line now.
It really set up, I mean, in terms of, authorities, government, regulators, it's up to facilitate institutional investor investment, or what do we need to see the governments and regulators do to make it more attractive and easier for them to invest in infrastructure debt?
I mean, again, the treatment overall could really, from our perspective, get in the way. And what the sorts of things, and I'd be interested to hear Conrad's perspective from the pension scheme side, but what's very important is of the asset class, and so we want a level playing field for capital. We also want stable and predictable regulatory framework, whether that's in PFI, PPP, solar energy, or utilities, and clearly we're in a difficult economic situation where governments are under pressure, and sometimes they do things they don't necessarily themselves want to do. But I mean, it's really those kinds of things that are big picture are useful, and things like procurement shouldn't be underestimated in terms of impact of some of those things.
So the capital treatment for insurers, as Silja was saying, it's a very important part of that massive part of the universe, and listening to the feedback that they're getting from the insurers, and trying to come up with something sensible that's applicable to infrastructure debt would be very helpful.
Okay, so we've had quite a lot of questions of the audience, and one I think that's quite interesting is a few people asking about the UK's pension infrastructure platform and whether that's a workable solution in terms of looking at debt investment. I mean, do you think about, you said that be transformational for the market?
Look, when it came out, everyone was incredibly excited. I think it's been a step in that direction. with that, I think, especially as a PIP, is that it's quite an organisation and they're trying to get a lot of people involved, but I don't think they've really set out a clear sort of in terms of it's going to be equity, it's going to be debt, it's going to be primary, who's going to be managing it. So I think that's put us definitely a step in the right direction, but I think we're not that close to that investment. I think in terms of just going back to the other question, just what can be done to facilitate investment, I think things like the PIP, definitely. I think the emphasis is really actually on industry players, the consultancies, managers, even banks actually come up with that. I think the only government can really do is just clear about what pipelines out there, what measures are going to be put in place to either guarantee or not guarantee. So at the moment, I'm speaking to clients, they're like, well, wait until the government guarantees. That we never know. So I think just a clear definition in terms of what is infrastructure, what the government aspect is going to do. And I think it then actually they shouldn't get involved too much. But I think the PIP is definitely a step in the right direction.
It's the pipeline that will lead to the market. And the pipeline that's lacking, not just the UK, but also elsewhere. I mean, for example, at the Benelux, we all talk about that being a great buoyant market. But we're still talking maximum a couple of years in those two markets. So it's not quite the deal flow that the market demands in order for this to make a step change.
No, I think that's right. These discussions are hypothetical. If we actually had a primary deal in front of us, we could all look at it and actually try and come up with a solution for it. But that actually occurred.
Yeah, absolutely. I mean, government sort of staying out of the way and letting the market come up with its own solution is really what you want. But the efforts that they're doing are certainly increasing the dialogue and that's helping with investor awareness and education about the asset class. So I do view it positively.
I think that's right. I think we're seeing governments starting to make moves to actually address the issue. So we've seen it in the Benelux region. We're in it with PF2 to some extent, where people are trying to address the idea, at least in theory, that pension funds and insurers need to come in. But the problem, I think, is that if you address it on a piecemeal basis, on a deal-by-deal basis, what's simply going to happen is that when the next deal comes along, which is a little different, it's just reinventing the wheel over and over again. So it's almost as if you need a more concerted approach from each individual authority or government to be able to say, that transactions, we address these issues in certain ways. And I just don't think we're quite there yet. But I think we're seeing enough dialogue to suggest that are moving towards that.
And just to pick up on the PF2 point, we've had a question asking what the recent thoughts are on PF2 and the impact it will have on institutional investment. Has this easier for institutional investors? Will it encourage them to invest in infrastructure debt?
Deals, right? My guess is that if you have a deal, there will be investors, and whether PF2 or PFI or PPP, some shape or form the deal will get done. But right now, we just don't have the deal flow. We have a concept that the development market was already following with equity going into the project companies, which perhaps is actually a bigger issue for some of the equity participants who themselves edged out of that market and the ones that were playing in equity. So perhaps less of a concern from institutional, but more that we still need to see the deal.
A question we've had is that someone has said that Allianz Global is not afraid of taking construction risk with their new debt fund. And specifically, one for you, Conrad. I mean, you mentioned that the smaller pension funds wouldn't be taking construction risk, but with the PIP and the sale of putting aggregating the pension funds, would that not mitigate that? Concern that they could go in it together to take on that construction risk?
Well, to be clear, I don't think small pension schemes are just saying no to construction risk. I don't think there's the appetite right now on the risk-adjusted relative value. I think whether you get loads of people together to take on construction risk or whether you go it alone, it's still construction risk. The underlying risk factor hasn't changed. Yeah, granted, it's more diversified and everybody takes a hit, but it's still construction risk. I think the PIP, the good thing about the PIP is that it does have kind of the gut backing to a certain extent to be able to potentially dictate terms, get some guarantees involved. With that, then probably if you want construction risk, that could be quite an interesting avenue to take up. But as it stands, it's still clear.
Yeah.
I'd agree with Conrad's point that getting some of these institutions to walk before they run is a good strategy. So focusing initially first round on that where there isn't construction.
I dare say AGI would say they know how to run, but I mean, in my view, in a way, is that there are parties like AGI, Allianz Global Investors, who can do that. And they themselves will probably recognise that there isn't enough of them right now. That change. So we're in a sort of transformational point in the market. But what we don't want to preclude an investor like an AGI or some banks that want to fund longer term, and equally some banks that are capable of funding in certain bespoke structures. So we need to create an environment that can allow that liquidity to play and not exclude anyone.
Which is more sort of an emerging markets focus. What is investor appetite for cross-border debt in Asia? Anyone want to kind of tackle?
At Elgin, what we see is investors wherever they are in the world wanting to carefully manage their currency exposure, and again with through regulations, that's something that's of course so much more. So I think that we see to some extent in Europe, and I think this may be also in Asia, that clients are needing to think carefully about whether asset liabilities are and trying to match those very much with the currencies that they have to that end. So, you know, liabilities in sterling, assets in sterling, liabilities in euros, and I'm sure that's the same for, across the world. Which is interesting, and that they well see mismatches in terms of where liabilities are and assets come in at some point in the future.
Yeah.
I've received some investor interest in both the sterling and our euro fund from investors that don't have liabilities in sterling or euros. So, you know, but I wouldn't see that as a game changer. It's more around the periphery.
Yeah. Okay. And going back to the attitudes towards the procurement process and everything like that, what are pension funds' attitudes and insurance companies' attitudes towards bid costs and the costs of projects? I mean, obviously these are things that they have to take on if they choose to invest on the primary side.
I haven't actually taken a client through that process yet, but taking a step back, there's much low-hanging fruit that you can just get the returns you want without having to go through that process. I think one of the difficulties is speaking to a trustee about an opportunity where it's not easy to successfully get the bid and then take on construction risk. And it just seems like a lot to get past. There's a lot of hurdles and a lot of things you have to jump before you actually make an investment. I think that makes it harder. If there was some guarantee process, which is unlikely, and obviously it'd be a lot easier to consider.
Okay. And, quite a few questions about Solvency II, and I'd like to just briefly cover this as we are coming towards the end of the session. But one can give their views on what the impact of Solvency II will do to institutional investor appetite for long-dated infrastructure investments. I don't know if that's for you.
I mean, I think we would see that institutional investors like us, like other insurers, could have significantly greater appetite, firepower in BBB, not for what we probably would see as very artificial regulatory constraints in terms of the limitation overall of BBB exposures. And that would be something that it's not news today, and we would expect that to be something that the regulatory discussions will have to take serious note of, not just because it's for infrastructure, but because it's done for the wider economy and thinking about growth, and because there are certain asset classes where there's robustness at BBB over the long term that you really deny yourself and your clients, you know, your annuitants at the end of the day, significant amount of value if you just leave it on the table and stick only to single A. And very large investors like our internal clients and very large pension schemes, you just can't afford to invest below your maximum optimum level in any area, and we would expect that which is the limit, which we think is one of the big issues. We would expect that to change in time, hopefully with with consent on all sides, and that's potentially the biggest impact, which is really positive when it is resolved.
Just quickly,
yeah.
I think that Solvency II actually affects pension schemes as well, because if you ask most trustees what the end game looks like, it's buyout. So actually how infrastructure debt gets treated under Solvency II will dictate how much they can hold. So if they want to go buy, they have to sell their assets. If an insurer says, I don't want that, suddenly pension schemes are going to look at other assets that might well too. It might have been there, then 10 years' time actually be able to do a buyout.
That's an interesting point. So I just to ask you all for your brief closing remarks. Alistair, if I can start with you.
It's a very interesting market, and obviously demonstrated by the amount of discussion about it. And what's been around for a long time, but we're getting to the point where finally investors seem to be making that leap. Obviously, with our format Pebble, what we have also sought to do is make it an open format, one for anyone to make use of and to apply as they see fit. We've been making steps to put that available on IPFA. So to the extent that people want to comment on that, we're still seeking input and looking to make the first standard form of that in the coming months.
Silja?
On behalf of our clients, we're actually quite positive about 2013. We think it's very much moving in the right direction, and notice that there's a lot of support across Europe really for the infrastructure sector and institutions. And so we look forward to Pillay basically and working hard to get investments on our books.
Yeah.
I think we're encouraged about the increasing dialogue. It would be great to actually see more transactions occur, and we're hopeful that that'll happen in 2013. Certainly in the 3 years that we've been together as a team at Sequoia, the dialogue with investors had changed markedly from when we first called on people and they knew very little about the asset class to now where we can really have a dialogue with institutional investors participating. So we're looking forward to seeing how it develops in 2013.
I think the sentiment echoed around the table has actually been generally positive, and we are definitely in that positive space as well. We've been a bank that's been able to do long-term lending for a while and will continue to be able to do that. I think it's actually very encouraging that there are investors out there that are actually also interested in this asset as a long-term proposition, and that is a very positive statement. So we see the market developing in a very positive way, and we certainly echo the sentiments of everyone else saying that pipeline is the fundamental issue in being able to work out exactly how we will see these structures developing and working and coexisting with each other going forward.
I think everybody's covered all my points, rather annoyingly, but I think 2013 is probably a good year for institutional investors. I think PET schemes, if this could be devised to get a construction risk, I think everything will go okay.
Dee, did you want to add your closing remarks?
Maybe just to say that 2013 will effectively be a very interesting year to see how the access to this asset class will develop. There's been a lot of initiatives which have been announced and developed in the market in Q3, Q4 2012, and hopefully this will be concrete now. So to access this asset class for investors, which we've always been convinced that this definitely makes sense for investors in terms of long-term investments.
Thank you very much. I think I agree that was a very interesting discussion, and there's a lot of points there that should make 2013 quite interesting. I'd just like to say thank you to all the panellists who've made this a thoroughly engaging debate, and thank you to all of you for listening. Also be available online within next week to listen to if you listened or missed anything.